Self-Directed IRA Rules. Hey everyone, Adam Bergman here, tax attorney and founder of IRA Financial. On today's video, I want to educate you on the rules that you need to know if you want to use a self-directed IRA to make an investment. So let's get started at the top. What is a self-directed IRA? So essentially a self-directed IRA is an IRA based on section 408 of the code that lets you do alternative assets. So the difference between an IRA you'd open at Schwab, Fidelity, is they're only going to let you do traditional investments like stocks. Whereas a self-directed IRA will let you do alternative assets such as real estate or cryptos or gold or private placements or hard money loans. What are the rules? So let's start with the first self-directed IRA rule, and that is the prohibited transaction rules. And basically this says that there's only 3 things you can't do with an IRA. That's it, just 3. What is it? Number 1, collectibles. You can't buy art, baseball cards. Number 2, can't buy life insurance. And thirdly, the broadest, found under Internal Revenue Code, section 4975, is you cannot do any transaction that in any way directly or indirectly personally benefits you or your lineal descendants, your parents, your children, your spouse, daughter-in-law or son-in-law, or any entities owned 50% or more by such persons. So you can't buy a house and live in it. Can't take your IRA and take your family to Hawaii or buy your wife a Rolex watch, or maybe your husband a Rolex watch. Can't do it. The investment needs to exclusively 100% benefit your IRA. So you can buy a piece of real estate with your IRA, rent it to a third party. The rental income will go back to the IRA without tax. Or you can buy real estate and sell it to a third party, and the gains will flow back to the IRA without tax. In that case, the exclusive benefit is being derived by the IRA and not you personally. And that's why it's not prohibited. So those are the first self-directed IRA rules to be concerned about, is the prohibited transaction rules. But there are really only 3 things you have to worry about: life insurance, collectibles, and prohibited transactions under 4975. So it really doesn't impact that many people. The second self-directed IRA rules to worry about is unrelated business income tax, or Ubit. Now, Ubit only gets triggered in 3 small instances. 1, if your IRA uses margin to buy stock, which isn't that popular. 2, if your IRA uses a non-recourse loan to buy real estate. Why do I say non-recourse? It's because code section 4975, remember that prohibited transaction section, does not allow you to personally guarantee an obligation in your IRA. So that's why the loan has to be non-recourse. And then thirdly, if your IRA invests in an active trade or business like a restaurant or bar that's operated through a pass-through entity like an LLC or partnership, the flow through that business income could trigger Ubit if it's above $1,000. Now you may be saying, hey Adam, what the heck are you talking about? I own business, shares in IRA, I own Tesla, I own Apple. That's a business. Have I not been paying this Ubit tax, which can go as high as 37% in 2022? No, you're good. Why? Almost all publicly traded companies, mutual funds, ETFs that invest in publicly traded companies are C Corps. Think of a C Corp as a big box. Box is in the income. There's a corporate level tax. So there's no reason for the Ubit tax to apply. Whereas an LLC or partnership, think of it as a flow through, like a funnel. There's no entity level tax. The income flows through to the members, and that's why the Ubit tax has to attack that type of income. So again, if you just think about prohibited transaction rules, Ubit, those are the only self-directed IRA rules you got to worry about when you're making self-directed investments. And best of all, if you work with IRA Financial, we'll be there with you, helping you navigate these rules, helping to educate you so you can be the best self-directed IRA investor possible.